So thank you guys. Thanks for joining us. Today's webinar, like I said, how to trade like an investing champion. And here's the disclaimer. Take a moment to read this. I'm not licensed. Nobody at Investors Business Daily is licensed. Mark can give his own 2 cents as far as any disclaimers he would like to provide. But here is the IBD one. And then, of course, our guest speaker, we're really lucky to have Mark Minervini, 2-time winner of the U.S. Investing Championship. Thank you, Mark. I know we had some issues trying to get this all set, but we got it going, and we really appreciate you joining us today.
It's great to be here.
Thank you. Like I said, Mark needs no introduction, I presume. 99% of you are here to hear Mark talk about the markets and some of his favorite screens, some of the things he likes to do in MarketSmith. I will be the co-host. My name is Scott St. Clair. I'm the manager of the Premium Product Group here at Investors Business Daily. Our agenda, because it's obvious everyone would love to know what Mark thinks about the market, especially after yesterday's action. So we will spend a good 10, 15 minutes on the current market, give him a chance to give his thoughts. He has some great screenshots that he's ported over that he uses for his private group. So that was really cool to see his thoughts on that. I've got a sneak peek at it, but we'll allow you guys to join in that. And then we'll jump into routine. We'll focus on his favorite screens, idea generators, the relative strength screens, and then the trend templates, which he helped create, say 3 or 4 years ago with the MarketSmith team. And then hopefully, I believe we'll have a time for a tiny bit of Q&A. We'll have to see. So Mark, please take it away. If you'd like, I can bring up a chart of the current market, but I know we talked yesterday. I did update this chart above, Mark, so it does show the action yesterday.
Yeah, so discussing the current market, the general market, we're certainly in a bear market, and I've been using a precedent that of 1990 going into 91, but I also have been using a precedent of 1962 because I feel like we're going to fall maybe somewhere in between or maybe closer to the 1962 analog. Now, of course, the market is not going to respond exactly the same, and it's starting to decouple a bit here. We're really looking very much like the 2022 is looking very much like 1991. If you take a look there, you can see how we rallied off the lows and kissed the 200-day, pulled back, and then started moving up. Now the difference is in 1991 we came ripping up that right side, and then it was pretty much a lockout rally from there. That's where I think we're going to stay out. There's the run up, and that was on the prospects of war of course in the Middle East. And then when the news broke, the market rallied, and then the bull market was off in earnest at that point. But we had bottomed back in October. So what I always say, bottoming is a process, and they don't just ring a bell. And sometimes the stocks take time to set up, and they don't set up right off the low. Sometimes they set up even before the market makes a low. In 1990, that actually happened. A lot of stocks I was buying, U.S. Surgical, Amgen, a lot of medical stocks and biomedical stocks were setting up prior to the October low. And then by the time you got over to that right side there, and you formed that big cup with handle, if you will, IBD ran a front page that said cup with handles proliferate, and there was all these charts of it was Microsoft, it was Costco wholesale. At the time, Costco and Microsoft were, believe it or not, relatively unknown names. They were mid-cap names. They weren't the big behemoths as they are right now. So anyway, getting back to the precedents, what I think, 1962. Do we have the 1962 also?
Yeah, it's this one, Mark, or would you like to pull it up
that's fine.
in MarketSmith? Because I can backdate the chart and grab it.
Yeah, this is good. 1962, you see, we followed a similar pattern where we bottomed and we didn't make much more of a new low. We came back kind of to retest that low, but it took a bit more time. And the result was almost identical. That run up the right side, you see how it runs straight up, and then it has that brief pause and then rallies. That's almost identical. Yeah, right there in October. that's almost identical to how 91 played out, although, but you had more time and you came back a bit more. So it got a little more scary. There was a Cuban Missile Crisis and various things that took place around that time. So anyway, that's, you know, I think that would probably fall somewhere in between that. If we look at, and I'm not sure if we have that slide, but if you look at seasonality, right now we're in the weakest period. September 6th through September 25th is the weakest part of the year. So it makes sense to pull back here and maybe, who knows, even retest the lows during this period. But the precedents, and you look at the historical work going, the seasonality, the cycle work, and looking at the presidential cycle, says that we bottom sometime in October, similar to the 1962.
I think it's funny you mentioned seasonality. I think I saw a chart where the S&P is actually the only month that's negative versus all other months, as far as if you just invested month to month. September is the worst month. Most people think of October, but the bad stuff tends to happen in September, and then the market will bottom sometime in October. And so a lot like this chart you have here. You've got just a simple overlay on your two analogs on how they are slightly different, but the objective is the same. You know, what this tells me is be patient. It could make another low, but you don't want to get out of the game because it could set up for a massive bull market in the future.
Quite the contrary. This is the time where you want to roll up your sleeves, do the work, and use MarketSmith. You know, I've been using MarketSmith in some form or another. When you go all the way back to the 1980s into 1990, I was using daily graphs, which is just the first version of MarketSmith in paper version. Now it's, you know, 100 times more powerful. You've got so many more tools. But the main thing to realize is that, like I'm pointing out here, is that it just needs time to build out that right side, whether it takes a short amount of time like 1990 or a longer amount of time. Now, the main thing is all this is based on how deep we would go into a recession. If we went into a recession, you had a really deep recession, of inflation keeps moving up and gets out of control, and they have to raise rates for an extended period of time, then you can start morphing into maybe a more 1970s type situation where the retest doesn't hold and you have to go lower and it takes even more time. That I don't think we're at that point yet. And the fact that we're starting with such negative sentiment already, I think that we've got somewhat of I won't call a safety net, but somewhat of a floor beneath us. Also, we had a last quarter, we were down more than 15% in the quarter. When you go back post-war, 1940, post-1940, when you have that bad of a quarter, especially after a decline like this, there was only one period, 1, 2, 3, 4, 8 quarters forward that was negative, and that was in 2008 when we had a huge recession. So it argues that, and that was about 11, 12% to the downside. So it argues that 10% to the downside is probably, you know, your worst case scenario if we don't have a very deep recession.
Okay, cool. And you know what I'd like to do though is I'd like to pull up MarketSmith, because you mentioned the ad in IBD about all the cups. I know David Ryan has told that story, but it's funny you say that because if you pull up, you backdate, I'm going to backdate the chart from Microsoft. Here's the cup with handle that you were talking about for Microsoft. That's the one you mentioned. Amazing memory that you remembered that. And Costco.
It lifts off, right? You see how
and
they
here's
lift
the one
off,
that you
right there
mentioned
up
as well. Yeah.
Right, they lift off right up that right side there, and you can see that they were already in uptrends and in a very strong uptrend, and then the weight of the market pulled them back and created that cup. And then when you form that right side, that's when the party started up the right side there. And there was a lot of stocks. You can look at Philip Morris at that time. You could look at, probably can't bring up Ballard Medical Products, but that was a
I don't think it's in our database.
That was
anymore.
a smaller cap one back then. T Square Medical, I can remember a bunch of names. Amgen, of course, was already making new highs. US Surgical, which is now delisted. But yeah, a lot of names. Yeah, you take a look at Amgen, see how the strong uptrend Amgen was in. I was buying Amgen right there as it was making new highs right there. Yep, right there. That's where I was buying Amgen, and I think Bill O'Neill was buying it around.
I was going to say that's the story that Bill tells about Chrysler, where him and Gerald Loeb were both buying Chrysler at the same time. Now we have the new story where you and Bill were both buying Amgen at the same time, because Bill doesn't. And he did mention, he said, I didn't recognize it here, but that's okay. You know, I caught it the next phase.
Yeah, exactly.
All right, so let's go back to the slides. Here's the presidential cycle that you mentioned.
Yeah, I would never trade off of this, but I am aware of the seasonality, and I try to look at everything, you know, in a homogeneous way. And you know, we do have a strong tendency, an upside bias there after the last quarter of the second year presidential year. So that will again would argue for, you know, a bottom here somewhere between October and January.
All right, and then I think last but not least, or no, second to last but not least, here's the when you talked about if we go into a recession, typically, obviously the markets have a harder time shaking that off, and you get another type of leg down. Which so this is your 73 when we did fall into recession.
Right. The difference between 73 and now is that in the 70s, there was a lot of political pressure for the Fed not to raise rates and not to get aggressive, and they got behind the curve. And now it's completely the opposite. There's support for the Fed, and they're moving quickly and probably going to get even more aggressive here. And that may seem like a bearish thing, interest rates going up, but I think the stronger the Fed moves here, the more the market's going to like it ultimately. And so I think a lot has been learned from the 70s, and we're probably, you know, going to avoid the situation that, you know, the doomsday that we're hearing from some people. I don't think that's the scenario. You can make that case today.
Okay, and then last but not least, as far as the overall market, here's the chart, and this is updated. I was able to screenshot yesterday's action, and you've got the put call trading across the bottom, which you highlighted.
It was holding up there for a while, and that was good to see. You know, when the market, you know, if you're having that pessimism in the market, if you take a look at the investors' intelligence numbers, you take a look at the AAII, American Association of Individual Investors, they're at very depressed levels as far as bullishness is concerned. Especially the AAII is almost at the lowest levels it's been since it started in 1988 or 89, I believe. So, you know, when you get all those sentiment readings bearish, and you get the put volume up, I like to see what people are saying and what they're doing. And when they start agreeing and everybody's calling for new lows, you know, you may get some more downside, but this is where you got to start looking for the leaders, you know, where a lot of the damage has already happened. It's already baked into the cake. Remember this too, and some of you know my 50-80 rule, stating that, you know, in a bear market, the secular leaders will go down, 50% of them will go down 80%, and 80% will go down 50%. It couldn't have been any more correct than this last cycle. You know, we've got some names that are down 80, 90%, and even blue chip names, you know, stocks like PayPal and Facebook, and these stocks are down 45, 55, 60%. A lot of damage has already taken place beneath the surface. So you got to keep that in mind, that, you know, when you're getting real bearish on the market, there's already been a lot of damage.
Yeah, the indexes, we have just done an amazing job, I think, of masking the true bear market, right? I think if this bear market had occurred in 98 or 2006 or something, the indexes would be down a lot more in line with the average stock is, like you said, has just gotten crushed.
Yeah, decimated. I mean, it's much worse beneath the surface. And also that was happening months and months and months before. If you take a look at the percentage of stocks above their 200-day moving average, it was below 50%, around 40% when the market was making new highs. So there, you already had that correction. So I would say that if we've corrected in the index for 6 or 8 months, we've been correcting really for 12 months to 18 months. So a lot has happened, and I think that, you know, we're probably closer to the end of this than the beginning, for sure.
Okay, great. All right, so let's go ahead and talk about some of your favorite ways to generate ideas. You mentioned MarketSmith, daily graphs, you know, along the way. And when we talked, you mentioned the thing that kept coming to mind over and over was relative strength. It was the one thing you mentioned over and over. And so there's a number of lists, but we'll focus on a few of them just to keep it simple. And let's start with the RS line, a new high list, which you'll find in MarketSmith in the bottom left corner in the subfolder called stocks. And it's just a list of all the stocks. It's sorted based on event date. So each day the new names will filter to the top. of each time that stock makes its relative strength line makes a new high. So talk a little bit about why that's important to you when you're looking for ideas.
Well, especially when you're in a bear market and the market's under pressure and you've got stocks going down, across the board, and generally speaking, that's when I look for what I call the sore thumbs. This is where the stocks that are the better names, the things that are happening with the company and they're in their own earnings cycle, they're sticking out like a sore thumb, and this is the time that it's easiest to spot those leaders because you're going to see this divergence or this contrast. So here's the first thing I want to mention about screening, because everybody always wants to know, what are my screening parameters and this magic screen. The thing about screening is the first rule you have to think is less is more. Okay, because think about this, if you put, let's just say you had all the criteria, the earnings, the sales, the margins, you put all the criteria in there, and let's say there's 100 criteria. If you miss on one criteria, then you don't see the stock. So the more you put in, the more you're increasing your chances that you're going to filter out a name that might meet 30 criteria, but it doesn't meet one criteria. So I actually screen much more narrowly, and then I go through them manually and I look at the fundamentals, and I start, I roll up my sleeves and I do the work myself, sort of the old-fashioned way. So that's the first thing. Now, what you're trying to do is increase your odds. You're trying to increase your odds. So looking at now, again, if you're a value buyer, then you're probably not going to look at the high relative strength stocks. You're going to be looking at different. But if I'm assuming most people here are going to trade like they're investing like Bill O'Neill or like myself. And, I've had many discussions, of course, with David Ryan. He's been my co-instructor for almost a decade at the Master Trader Program. So I've learned a lot about Bill O'Neill. And of course, prior to that, I had the pleasure of meeting Bill on many occasions. And Bill is going to would always buy the stocks that had the earnings on the table. So the way I do it, the way I use the screens is I'll run a relative strength screen. I'll run a screen that has the stocks in an uptrend, and we'll get to that in a minute. And I'll run the relative strength screen, and then I'll sort. I'll use the sorting function, which is a very simple thing, but it's extremely powerful. So if you wanted to find, say, the Bill O'Neill stocks, you run the high RS stocks. Maybe you run everything over 80, and you make sure you run my trend template, make sure they're all in an uptrend. Now you can hit the sort function right there and just sort under composite rating. And now that's going to give you the stocks that have the earnings, have the sales, have all the criteria, canceling criteria. Now, you want to trade like Mark Minervini? Mark Minervini trades very similar to that, only I'm in search of whatever's moving. Like I'm not, even if it doesn't have earnings, if it's a biotech, I'm trading whatever's moving. I started trading for a living. It was like I had to make money every day. So I got into the habit of trading whatever was hot, at that time. So I cast my net wider. So I would sort by relative strength, and I would look at the strongest stocks first, and then I would categorize them and take a look and say, okay, well, if there's no earnings, well, maybe it's a biotech, and then I would of course cut it some slack on the earnings because most biotechs don't have earnings. So again, this is now you can screen, you could sort under the SMR rating, you can sort under the percentage closest to the highs, to the 52-week high. You want to have stocks that are making new highs. The sorting functions, I think, are very underrated. Let's just put it that, or underused. And that's really a major part of my screening is just using the sort.
Right. And so, yeah, it makes it look, there are 361 stocks in the all RS line new high. And the only criteria, it's a wide net, like Mark mentioned, is show me stocks with a relative strength line is new high. And then Mark will decide, okay, do I want to take a stock like Rhythm? I think, like he mentioned, this is something he might take, but probably something that Bill might pass on because, right away I can see in the bottom left corner, there's no earnings, right? And they're just starting to get revenue, and it's very, very small. But something like TRMD, where, earnings, the sales are accelerating quarter over quarter and the earnings are starting to come in, that might be a name, barring size, of course, that both of them might take.
And if you cast your net wide enough, you're going to grab all those names that are performing well, and you'll also be able to see what areas of the market are showing the leadership, because you can sort, and I'm not sure if you have it in there in your functions there. Yes, you have industry group. You
I
can
have the
go
industry here, the rank. You could change it to the top groups, in other words,
or
right?
even industry name, and you can see now you see all those energy solars.
Mm-hmm.
So now you can see, and now of course, something like a oil group has a lot of stocks in it. So you have to sort of know if it's a semiconductors or oils, they have a lot of stocks in the group. So you'll see a lot of those names, but you start seeing that dominating the list. And now you immediately can find what groups also are coming up on that new high list, on that list of stocks and uptrends, on that list that are stocks that are relative strength lines are making new highs. And you start narrowing it down. So the whole key is to take the market down to the very best names and increase your odds by stacking the odds. And that's what MarketSmith is the best tool there is out there. Second to an institutional William O'Neill tool, and for the money, it's the best bang for the buck for sure. And like I said, I've been using it for 30 years, so it's all. I'm not sure what I would do without MarketSmith and daily graphs, because I started using it. I cut my teeth on daily graphs when we got the printed products and just flipped through the pages every week.
Yeah, and I'm dating myself as well, and I did that as well, and that I've got some of them saved here. They're very nostalgic. I refuse to throw them away. So
I have stacks of them myself.
All right, so let's talk about the RS line new high list that we just talked about is all RS line new high. The blue dot list takes two factors. The RS line needs to be making a new high. And then the proprietary pattern recognition algorithm that we have needs to identify a pattern, a double bottom, a cup with handle, et cetera. So it's a little more stringent in that regard. It takes two things for a stock to show up on this list versus the previous. And it's the same thing. You can see it's going to be in this bottom left corner under the stocks folder called RS line blue dot.
It does more of the work for you, and again, this is a great place to start particularly if you're just starting to use MarketSmith. Now, I've been doing this for 40 years, and I've been using MarketSmith in some form or another for over 30. So, and I'm still using the exact same methods that I've used from day one, a little more automated now. So you still don't want to get too complicated, even if you're advanced. All right. As a matter of fact, you may want to actually dumb it down. If maybe you're too advanced and you're trying to overcomplicate it, and you bring it down to, using the sort functions, like I'm saying, and widen your net a bit. But if you're just starting, this is going to put you in the direction where you're focusing on the very best names. You're going to see the top. There's not only so many names at any one time that you should be investing in. So maybe there's, out of 8,000 stocks, there's 300 or 400 that are worth consideration. And out of that, at any one day, there's a handful. So this is going to narrow you down to you're at least aiming at west, looking for a sunset. If you're going south looking for the sunset, it's not there. So you got to be aimed in the right direction first. So the two things are, the relative strength, staying in the upper end of the relative strength, and then of course I think we have or at least you could show this, is the trend template, which you can screen from the entire database of MarketSmith's database, or you can go to, and up in there, Scott, I don't know if you know the open stock ideas in the right side up there. That's
so this is I'm sorry, Mark, this is a screenshot, but yeah, it's but we will, let's fast forward a little bit, and we'll go to your template, and we'll do that. We'll bring up MarketSmith Live. Last but not least, the other one that you mentioned to me, Mark, is RS line within 5% of new highs. So again, another way to look for stocks that are strong. It's looking for the relative strength that's within 5% of a new high.
I love this. This is a new addition. And
correct.
This is an excellent addition, because this gives you a heads up now, and it tells you when the RS lines are getting close to making those new highs, and now you get a little bit of lead time. This is going to turn into like the January effect. And when you had the January effect, everybody started anticipating it. It started happening in December. Then everybody said, you know what? People are anticipating this. Happens in September. They started anticipating the anticipation, and it happened in November. Before you know it, went all the way back to January. So I'm not sure if this is going to happen with the relative strength lines, where now we're going to start looking for when they get close. but this is a great addition to MarketSmith, and I love it.
Right. So this is the screen that I created. I was speaking with Mark earlier this week. So like he mentioned, you can screen for within 5% of new high. It's pretty simple, yes or no. And over here is the kind of the cheat sheet for the screen. I have filtered out the ETF and closed-end funds. You don't have to, but I just did that in this case. And there are 690 stocks in our database that have our RS line within 5% of new high. And then you just click the screen results. And initially they'd show up down below here in alphabetical order. And then based on Mark's recommendation, you can sort by RS rating or comp rating or percentage off high, any of those factors.
Or you can put in a cutoff. Like I would probably put in a cutoff at 80 or RS. And then now you've narrowed it down, and again, this is narrowing it down to the better names. Now, if you're a growth momentum trader, you're going to want to be in that the majority of the stocks that I traffic in have an 89 or better relative strength. That's sort of my mental cutoff. I do go below that at times, but 90% of the stocks that I've traded for literally 30 years, maybe even more, but going all the way back to the 1990s, 90% of every name I've traded has had an 89 RS or better. So it's unnecessary to go down into the junk pile, as Bill used to call it. And again, maybe you set it at 80, and that will narrow this down. I don't know, what does 89
it
do?
It didn't narrow it much. It took it from 690 to it's thinking 622. So we lost.
That's 80, right? That's
names.
80.
Yeah, that's with 80.
If you put 89,
so you can play with it. You can see,
Yeah.
If I put in 89, like Mark mentioned, it's going to narrow it a little bit, another 200
knock a couple
or so.
hundred off.
You got it. Yep.
Now
we're down to 404. Yep.
Right. So now you're honing it down. You're honing it down. And now again, if you go, we'll get to it in a second. If you apply the trend template, and instead of going through the whole database, you apply the trend template, now you're going to get the stocks that are in uptrends, and you're really going to increase your probabilities, which when we get there, I'll tell you why in a second.
All right. So first of all, I'm going to show them, let's show them where the trend template is, so they just know how to find it, just the general. And then two, it's a great idea. We're going to build a screen with your trend template. You tell me which time frame, and then we'll add in the RS line within 5%. And let's see what the results are. I don't know what they would be. This will be a live experiment, so to speak. So in the bottom left corner below, like the RS line blue dot and RS line new high, you'll see the trend templates, which we named after Mark. Minervini trend, 1 month, 1 to 4 months, 5 months, 5 months wide. You can't see it because due to real estate, but there we go, 5 months wide. So if you could give us a little feedback on the why 1 month, why 5 months, and are there any that are preferable for you?
So the majority are going to be on the 5 month, the standard 5 month with it, which is a confirmed, what I call a stage 2 uptrend, with which of course my good friend Stan Weinstein, which I'll be having actually dinner with this week, we'll be talking about stocks quite a bit because he loves talking stocks. That's where I started learning about the 4 stages of a trend. I met Stan in the early, actually it was in 1990, right around that bear market, and read his book, and he convinced me that you want to be in only stocks that are in stage 2 uptrends. The other 3 stages are what he calls the bad guys. The good guys are the stocks in the stage 2 uptrend. So now here's the reason why you want to have that stage 2 uptrend. If you go back and you look at Bill's work and you look at the precedent analysis that we've done, him and I, and going back to Richard Love, who we all based our work off of originally, 98% of the biggest winning stocks, those are the studies, of course, that Bill based his whole CanSlim on. 98% of those stocks are in a stage 2 uptrend before they make the big move. So I always ask this question: Would you rather have a 98% probability of finding a big winner or a 2% probability? Which club would you like to be in? I want to be in the 98% club. So if you're trading a stock that's not in a stage 2 uptrend, it's below the 200-day moving average. The 200-day moving average is moving down. Yes, maybe you get, you're fortunate enough to grab a stock that's, bottomed and you get a big winner. But the probability is about 2% that it's not going to make a big move until it gets in. So why not just cut all that time away and go and cut right to the chase and get to the stocks that are, in position to make those fast velocity moves and the magnitude moves. And that's what this does. So the 5 month is a confirm. That's where you're in an uptrend for 5 months. The 1 month is the reason why we did a 1 month is because for power plays, which is just a reterming of high tight flags, they sometimes will explode so quickly that it doesn't give the 200-day enough time to get into that uptrend. So you'll find David Ryan has told me that he runs the 1 month pretty much every day or once a week. That's one of his go-to screens. He runs that 1 month, and I do too. And that's where you'll find a lot of the power plays, the high tight flags, and the stocks that's sort of the heads up too. You'll see the stocks that are starting to turn into those uptrends, but they're not confirmed yet.
Great. Okay. So you've got the 1 month, the 1 to 4 months, the 5 months, and the 5 months wide, which has just turned off the relative strength. The 5 months I believe, has a relative strength of at least 70 for it to make that. And there's currently 168 names. So let's talk about the screener that Mark talked about, screening the trend templates. So
and Scott, not to interrupt.
Go ahead. No, please.
You just brought up another point by bringing those stocks up. There was 160 names. I remember back when the market was strong, there was almost 1,000 names. So that in itself gives you sort of a read of the health of
a bit, right? Yeah.
Yeah, that sort of gives you though a read of the health of the market. When you've got a lot of stocks in uptrends, and certainly when you only have 160, then all of a sudden there's 300 or 400, and then there's 500 or 600. Now you can see the market's moving in the right direction, and we're getting, the good guys are starting to take over, and that's what we're looking for. So there's even more beneath the surface to read from that. But yes, in the market, when the market gets healthier and you've got a lot more names, you're going to want to narrow that list down even more. It may show a small amount of names now, but it will pull quite a number of names when the market gets into a strong uptrend.
Great. Yeah. If anything, if you just looked at those names each week, you could kind of get a feel for, as the market slowly improves, by just like you said, the number of possibilities.
Yeah.
Okay, so I have the screener open in MarketSmith. How do you open the screener? If you're new and if you're on a chart, on the left-hand side, there's a tab called Screens, Alerts, and Notes. You would just slide that open and click the button that says New Screen. And you can screen for stocks or mutual funds. So you would choose stock screen. And I'm going to call this Mark Webinar Screen. Oops. No surprise, typoed it. I'm going to save it. And initially, when you start a screen, it's going to screen from the entire MarketSmith database, which is currently 9,686 stocks. That's about, I would guess, 3,000 to 4,000 ETFs and closed-end funds. So probably somewhere around 5,000 stocks. But we're going to change this to Mark's template that he talked about. So I'm going to click on this database. And this little pop-up box is exactly what you would see in the bottom left corner. So we're going to go to reports. We're going to scroll down, and there's the 5 months that Mark talked about. We're going to select that. And now when we screen, we're screening from the 168 stocks that he mentioned. So what you want to screen for RS line within 5%, or how should we narrow this list, do you think?
Well, I would say you can narrow it down, maybe cutting that relative strength off at maybe, probably no less than 80, or you can go to 89. There's a pretty tight list right now with 168 names. That's a very small list. So, maybe cast a little bit wider net, but yeah, you can narrow that down a bit. And that
they all have an 80 or better. Wow, there you go.
You see, so and that's because, that's because the market's in a downtrend. So any stock that's in an uptrend is automatically picking up RS. So now if you bring it up to 89, you're probably going to narrow it down a bit.
Probably cut it in half. Let's see what happens.
Yeah, you're definitely going to narrow it down.
Wow, 164.
Imagine
that's
that.
Amazing. This list is strong as an ox. So
right.
Yeah.
And again, that's because you're having stocks in an uptrend while the market is in a downtrend. So they're picking up relative strength. It picks up even if your stock moves sideways. If the market goes down, then your relative strength is going to pick up, or at least, against other stocks in the market. And there's so many stocks that have gotten annihilated that any stock that's in an uptrend is obviously picking up some very strong relative strength against something, like a PayPal or a Facebook.
Let's go ahead and just sort the list. So we're going to click on the RS rating column header down here.
Now,
All
another thing
right.
I would do, Scott, is that I would eliminate, I personally would eliminate the ETFs and, out of there. I generally, if I was going to do a screen for ETFs, I do a separate. So you can go to,
I don't think your trend template has ETFs, Mark, but let's find out.
I'm not sure if I might have told them to cut that out. I
I
can't
think you,
remember.
yeah, I think it's been filtered out
You might be
pre
right.
already, but
Closed end. Yeah, I would take
let's
closed
find
end
out.
and ETF, both of them.
Yeah, my gut instinct is, yeah, see, they've been
How
removed
about
because it
ETFs?
didn't change it.
How about ETF, regular ETFs? You have closed end funds. How about, yeah, I think you're right, though. Okay, so it already does that. That's good. That's good. Because I would have done that if it wasn't.
Sure.
I can't remember. We programmed this so long ago. I don't
Yeah,
really
it's
remember
it's
that.
about 4 or 5 years since this has been first created, I believe,
Yeah.
right?
Yeah.
So here are the stocks sorted by relative strength, and then if you just double click the very first stock, it would pull up the chart. And then I don't know, Mark, for you, I prefer the space bar because I can move from stock to stock at my own pace. How do you?
I
There is
use
a
this.
play button, so but how do you handle it?
I use the space bar. I actually learned that. I didn't even know you can do that until years ago when Arusha came to the Master Trader program and we were going over MarketSmith. He hit the space bar and I said, "Oh wow, that's pretty neat." And I learned that.
Yeah, it's kind of a hidden gem, right? And it allows you to move. You might spend 5 minutes on one and 5 seconds on another. So I found the play pause was not very efficient. So yeah, I think the space bar is best. And then, if you have the pattern rec on, you can quickly see here's Antero Resources. It's building a cup with handle. And now you can evaluate that stock if that's something that you're interested in.
Now, if you want to get the stocks that have the earnings, you can sort right now, sort by EPS rank. And now you're going to get the stocks that are in uptrend. You got the relative strength, and now you'll get them in order of the strongest earnings profile descending. And you should be starting looking at the strongest first. So now you're going to see the earnings are going to be there. When you sort this way, you're going to get the earnings. Now they say, look at the earnings and sales. Look at those giant earnings and sales and margins there. So now you'll go in descending order.
And so the EPS rating is right here. You can see it's a 99. So we'll start with the 99s. And then do you look at daily first, weekly second? Do you use both time frames? How does your kind of routine analysis jump in at this point?
I look at daily first, and I always look at a weekly. So I want both charts to look good.
And you mentioned, so we know that relative strength is a factor. You mentioned the EPS rating. You mentioned the composite rating. You did mention the quarterly earnings. I think you even mentioned the margins or return on equity earlier. And so these are things that you would use to evaluate an idea and as possibly something to go with.
Well, earnings definitely, and sales and margins. That's really when it comes down to a growth stock. That's pretty much the engine. If the earnings, you got to remember this. A stock is only going to go so far without earnings. It's going to be shorter lived. And if it has margin improvement and no earnings, then what that means is that then there's productivity enhancements, there's cost cutting, there's things that can maybe move the stock for a short period of time, but they're going to be on limited life support because you can only cut costs so much. You can only improve productivity so much. Eventually, revenue has to come in. So you got to have that revenue, and you got to have those sales. And when you get it all, when you get the what I call the code 33, some of you that read my book know what that means. That's where you have the accelerating revenue, accelerating earnings, and accelerating margins. That's where you just get a very powerful situation. But again, the relative strength, as much as we're talking about the earnings, if the earnings are there, I would never. It doesn't matter to me if it's not in an uptrend, the stock doesn't have the relative strength. Then you have to ask yourself, if the company's so great, the earnings are so great, why is the stock not performing? There's something wrong.
Great. So as far as the kind of order of importance, you're definitely gonna, want stock performance, price, trend,
relative strength, the chart pattern, then fundamentals. Then you bring in the earnings, sales, margins. Now return on equity is the issue with that is that depending on the industry, that's more of something that you have to compare across industry group, because now, a software company has very high return on equity. Even margins, you look at a grocery store, they're gonna have 1 to 3% margins. Now you look at a biotech can have 80% margins. So now these are getting into things that you have to understand the category you're in, and then you can make a fair comparison. It's not just an apples and apples comparison.
Yeah, so Walmart might be best in breed on return on equity, but it's half of what Microsoft's return on equity is. So it's very industry
Exactly.
specific, right? Okay.
Right.
Okay. So let's scroll through some of these ideas here. So I think CF was the very first one. Clearfield, which was acting really well, and then it's kind of faltered. And do you get any kind of feel about the market as far as the setups? Like, oh, there's a lot of oil and gas setups. Therefore, that gives me kind of an idea on the market. Shipping has held up pretty well. There's FLNG down here.
Yeah, well, we have a real lack of growth right now. Growth got crushed and we went into cyclical. And the problem is with cyclical is cyclical. It's not saying that's why they call them cyclical. So when you get into the papers, the oils, the commodity driven type names, steel, these tend to be, they have moves, but they're shorter lived. And then you get a lot of volatility. So, I'm looking for the growth. Now, if you take a look right now, and you look at IBD and you look at the group section, the industry group section, where you rank the 197 groups, 198 groups, you've got solar. That is number one, and it's been number one for a while. And if you take a look at the stock, it meets all the criteria that we just talked about. ENPH is in my opinion, one of the main leaders there. But the whole group is looking really strong at this point. So that's a name that even with the market under pressure, that we're still in at this point.
And here's the relative strength is the markets. You can see I've got the index across the top. So the index is going down and this stock is going sideways to up. And that's where that relative strength brings the idea to you.
That's right. That's right. And this you're hitting on pretty much all cylinders too. As you can see too, you've got a composite rank of what's 99, 98. So that's
99 and EPS of 98 and, quarterly earnings last quarter up 100%. So, and, relative strength 99's got all the factors.
That's hitting on all the cylinders. That's performing quite well right now.
Great. Okay. So I think we can maybe have some time, unless there's something you wanted to talk about that we might have missed, but we probably have time for some Q&A.
The other sort function that is absolutely worth its weight in gold in MarketSmith is the IPO date. So that's another. I run a specific screen just for IPOs, and all I do is just say IPOs in the last year, and then I sort them. Again, the sort function. I sort them in date of the earliest first. And then I hit the space bar, and you'll get the most recent, and it'll just keep elongating, and the charts will get longer and longer and longer. And you'll see pretty much everything that has been an IPO in the most recent, year. So the reason why you want to do that is because these are what I call magnitude opportunities, where it's the earliest you can get on board, other than, pre-IPO or on the IPO day. And when you look at the biggest winning stocks, most of them, 80% of them, were IPOs within the previous 8 years or so. So that's why they're relatively new companies. The stocks that make really big moves are usually relatively new companies, or at least new stocks. Like Krispy Kreme, has been around forever, and it went public, after it was a company for I don't know how many years. But some companies are companies for 50 years, and then they go public. But they're since they went IPO, 80% of the big winners are IPO within the previous 8 years.
Right, and
So,
you can
if you can run that now. Yeah, of course. I think you went back.
I used 2021 to 2022, but if we just use this year, like you mentioned, so we'll do the start date of IPOs for just this year. It's probably pretty light. I have to admit, I don't know the number, but yeah, 56 in our database.
So now you can go. Do you have it in your sorting where you can go to the IPO date?
It's probably right here. Yep. Oops. Do I have it? I had it sorted by IRS already. So let's go ahead and change it. So IPO date, September 9th. was
Yeah.
the newest one, and you can
Okay.
see, let's go to the
Go
daily,
to the
but this
daily.
is the
Yep.
newest one, this
There you go. Now hit
Yoshi.
the space bar and just keep hitting the space bar and watch. They're going to get longer and longer, and you're going to see everything in chronological order of what went public. And you're going to see all the new issues, all all your IPOs, all this the companies that you should be focusing on as potential new leaders.
And slowly but surely, as the market gets better and as they trade longer, you'll start to see bases potentially, right? Not all of them
Yeah.
are going
I
to build
also
a
put an
base, but
RS. I do put, sorry to interrupt, but I put an RS cutoff on this one too. I
oh,
usually,
okay, let's
yeah, I
do
usually
that.
put like a 60 or something just to, you can put an RS cutoff and
All
you'll,
right. So we're going to make a minimum RS of at least 60,
yeah, that's going to knock it down. And
17
see, now you got
stocks,
17. Yeah. See that you're
which,
really cutting it down now. And now you can probably, and there you go. That's a nice big cup of handle. It needs a little bit tightness on the right side, but that's forming pretty nicely.
and that will keep you on top of all the newest names like Mark mentioned.
There you go. Now you're seeing stocks that look a bit more constructive.
Okay, all right. So let's jump to the offer. Thank you guys for joining. I know this is free access week, so a lot of you are able to view the charts and play with MarketSmith till Sunday. I believe it will end on Sunday. But we do have a special webinar offer. You can try MarketSmith 4 weeks for $24.95. Don't hold me to the math, but that's a lot off, maybe 70, 80% off. MarketSmith normally $150 a month, and you'll get it for $25 for 4 weeks. You can take that link, investors.com/webinar offer, or you can call us 800-831-2525. Any final
Scott, real
thoughts?
quick.
Yeah, please, we have
Yeah,
time, Mark. So any final thoughts?
I don't
Yeah,
know if we were going
please.
to do Q&A or not, but just
Yeah, I
two
think we
real quick
can. Let me
things.
check with the people in the background, but I don't see any reason. Well, I'm not going anywhere. So thanks, Mark. Let's go.
If you guys want to, a couple things. One is that this program, this tool, MarketSmith, is extremely powerful. I could stay on here for hours and go through so many ways, but 98% of everything I do is just, you just saw. It really encompasses, that's going to lead you to all the names that you need to see. So you want to keep it simple. It's really important. Just really quick too, I want to talk about how the upcoming Master Trader program, MarketSmith is our sponsor, and Arusha, I'm not sure if it's going to be Arusha this year or who it is, but Arusha's been there every year. And we have a day where we spend with MarketSmith and we go over the screening and we actually put it into real life trading. So at the same time on live trading day. So real quick, just a shameless plug.
Good for you. That's okay. So I have some questions that my team is cherry picked, and it's all gamuts. I guess one of them is stop losses. So you buy a stock. How do you kind of consider or think about your stop loss? Do you put an actual stop loss on the book, et cetera?
Well, I never ever enter a trade ever without knowing where I'm getting out first. So I know the out, I know the stop before I ever even get in, and that stop is ingrained in stone. So when it hits that level, I'm out. Intraday, no waiting, no vacillating, no seeing how it closes. I'm out, right? That's the amount that I'm willing to risk. I'm not risking any more than 5 to 8% maximum. My uncle point is 8%. I will go to like maybe 10 if I do what I call a staggered stop. So by that, I could still have the same 8% maximum stop. If I do, part of it at 6% and part of it at 10, that's 16% divided by 2, 8%, that would give you an 8% loss. But I'm still making sure that I average on my worst case scenario, 8%. And my average loss, generally speaking, in a good market is 3 or 4%. In a tough market, it's 5 or 6%.
Great. Okay. And everybody, I assume most people know, but just in case, if you're new, he's talking about his cost of capital. So if he buys something at 100, that's where the stop comes in. If it goes from 100 to say 110, then I'm let Mark tell the story, but I'm presuming that he makes some changes along the way.
Right, that would be a different story. Now you might, you might want to move your stop up. Usually once the stock gets up a certain amount, then I start backstopping, I start protecting my break-even point, and then of course eventually crimping it off in and locking in a profit. But we're talking about just if the stock goes against you and you're at a loss.
Great. Okay. And let's say today was Sunday, if that's when you do your work and you sit down to your MarketSmith, what's the first report / screen that you run? And is there any kind of significance to why that's the first one? In other words, could that be
Sure.
your favorite?
I run the relative strength screen always first. That's what I've been doing for as long as I can remember. And that's because I want to see what's performing in the market, what's holding up the best, what's performing the best, and that's what's going to lead me to the better names. If you can't, this goes all the way back to Jesse Livermore. Jesse Livermore said, if you can't make money trading in the leading names, then you're not going to probably do very well in the lagging names. So, there are times where laggards can play catch up and so forth, but a healthy market, you want to be in the leading names, and that's where you're going to find them. So that's number one. If no matter what the stock, no matter what the stock has for a product or earnings or sales or margins, if it's not in an uptrend and it doesn't have the relative strength, then I'm not even looking at it.
Great. And then Jonathan asks, what about liquidity volume? Do you consider that at all when you're looking at stocks? I'm going to presume so, but again, I'll let you answer.
As you get larger, liquidity becomes an issue. If you're trading, of course, a mutual fund, it's a huge issue. Now, what I do is I don't cut it off. I'll screen all the way down to 50,000 shares a day, but I'll buy 1,000 shares of that. So you just have to a position size accordingly. If it's a really thin stock, the thing that I always say is that I'd rather have a small position in a stock that doubles or triples than a big position in a stock that goes nowhere. So I'm gonna look at the really thin small names, and I'm just going to position size smaller.
Great. It's good to know. So, we have at IBD, they have kind of a standard rule. You use the same position size, but when you think about it, it's like, well, if I do that, then sometimes I might have to pass on a stock, like you said, that might go up a lot. Why can't I just have, instead of X amount of shares, have Y amount and participate if it works?
Yeah, if it's not going to move the needle, you're running a hedge fund or a mutual fund or professional money. Yeah, then you have to get a certain amount of size on it. It's not going to move the needle. But usually with an individual portfolio that's trading anywhere between a couple hundred shares and maybe even up to 5,000 or 10,000, liquidity is not an issue. And then if you are trading 5,000 or 10,000 shares, then again, if it's trading 50,000, 100,000 shares, then you want to temper it down to maybe 10% of the average daily volume.
Great, cool. All right. Morris asks, how frequently do you screen for stocks? Like, is once a week enough, or do I need to be in here every day? This is what you do, so you probably have more time than Morris. Maybe he's an engineer or something. What would your recommendation be for somebody like that?
You can certainly, once a week is going to give you, you're not that much is going to change throughout the week. However, of course, some things will slip through the cracks, of course, throughout the week. I screen the big screening on the weekend, and then I do lighter screening throughout the week. And it depends. If the market's doing really good, there's lots of stock showing up, then I'm going to do more screening, and I'm going to start trying to turn over more stones. When you're in a bear market and there's just nothing coming up, after doing this for 40 years, sometimes I know, there's really I'm not going to find a whole lot here. Everything's in a downtrend. Not much is coming up on the trend template. So, I'm looking a little bit lighter, but yeah, I screen, every day. I screen every day, some screening every day, pretty much. And that's what you should be doing, running those screens. With MarketSmith, the way it is now, it takes just a few minutes, and it might take you 30 minutes to thumb through them.
Yeah, I mean, the trend template is 78 names. If you reduced it with some type of filter, you could get it down to 50 names, and that might take you 20 minutes on a Tuesday afternoon or a Tuesday evening, right?
But Scott, even if you had more names, if you do, I love the feature that you guys added, where on the iPad you could actually have multiple charts now, and you can have multiple time frames. So you can have the daily, the weekly, and you just scroll through them. If you haven't used that yet, take a look on the iPad. It's a great feature. I use it on my phone, right on my phone. I mean, sometimes I'm at dinner, and and there's I got a little bit of time where I'm waiting, to be seated, and I start flipping through on my phone and start looking, running my screens. You can run your screens right on your phone. So that's why it's a great program.
Yeah, that is David Ryan talks about that feature as being one of his favorites too. Currently, unfortunately, it's not browser based, but it is on the iPhone and or the iPad, right?
The
Like you
reason why he
mentioned.
talks about it is because him and I lobbied for it for like 5 straight years.
Yeah,
I don't know
and
if we're the reason why it happened, but we pushed for it for about 5 or 6 years.
I think you had something to do with it for sure, and it was Arusha's like it was his going away gift to us. I think it was one of the last things that he pushed through when he was here with the programming team.
Yeah.
So somebody asked here, what's your daily routine like? What do you do typically in a normal trading day?
So I do all my screening the night before. So when I come in to trade that day, I already know the stocks that are on deck, the stocks that are, have buy points, and I've really made all those decisions. I've already added my in the morning, I put in my alerts. I have audio and visual alerts. They'll pop up if the stock starts moving through a pivot point, breaking out to new highs. I'll get an alert, and then immediately I can trade that. So I prep the night before, and then when I go into the trading day, I pretty much have everything mapped out, and I do that. My final alerts are set in the morning, and then I just take a look, where my open positions are, and I'll readjust my stops if I need to, and that all happens pre-market.
Great, cool. And somebody asked about your execution. Do you execute, throughout the day? I think based on the stop loss factors you mentioned, if the stop is hit at, well, my time, 6:31 in the morning, your stop is hit, my stop is hit, it's time to go. But do you
Yes.
find initiating positions, is there a better time of day? The old adage, amateur hour. I don't know if do you think that still exists? The first hour was considered amateur hour, so to speak.
I think it's somewhat, in the first 10 or 15 minutes, you can get some volatility. David Ryan tends to stay away from, the initial trading, tries to avoid the first 30 minutes of the day. I take it sort of with a grain of salt. If something gaps in the morning on low volume, I might, I might avoid it. But I tend to just, I'm very much a proponent of letting the market speak to me, and I'm a caboose and I follow the train. So I try not to have too many of those biases, and I trade whenever the stock breaks out. I'm in.
Perfect. Great. Okay. Well, Mark, thank you. I'm going to wrap it up here. Awesome, Mark. You really, it's really a pleasure to have you on here. And this is my first experience. I get to take Arusha's place. So he just texted me, and I think he's a little jealous. So, so we really appreciate it coming on board. Last but not least, the special offer today, 4 weeks for $24.95 online, or the 800 number. It is free access week. So if you sign up today, we will add another week for free. So in essence, from today, you will get 5 weeks for that $24.95. Make sure if you call us, mention that. If you sign up online, you might want to email us to add that extra week if you were to do that online. The email address to contact us is marketsmith@investors.com. Thanks, Mark. Thanks for joining. And thank you, everybody, for taking your time on this morning, this afternoon.
I hope this has been helpful. Take care.
It was great. Thank you, Mark. Thank you so much.
Okay.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.